Investing your hard-earned money can be a daunting task, especially when you're just starting out with a small amount. With just $100, the options might seem limited, but in reality, there are numerous avenues to explore, each with its own set of risks and rewards. Whether you're interested in the traditional stock market, diving into the world of real estate, experimenting with cryptocurrencies, or even investing in timeless assets like gold, every choice offers something unique. The trick lies in understanding your goals, appetite for risk, and the type of income stream you're hoping to generate. In this guide, we'll take a deep dive into 5 of the most popular investment options available today, each offering a different approach and a variety of ways to grow your initial $100 investment. From individual stocks to real estate investment trusts, REITs, and the ever-popular cryptocurrency market, we'll break down the benefits, risks, and what it takes to succeed in each area. Alright, you've asked me this question more times than I can count. What's the best way for beginners to start investing online with just $100? As someone who's been in the investing game for a while, I get it. Taking that first step into the world of investing can feel intimidating, especially when you don't have a lot of capital to start. So, 4 years ago, I set out to answer this question for myself by investing $100 in 5 different online investments. Today, I'm going to share my results with you and finally give you the lowdown on what worked, and what didn't. We'll be comparing these investments using a simple grid. We're looking at 5 categories. 1. Learning curve, how long it takes to get the hang of each method. You want it to be easy, right? 2. Passive income potential, can the investment make you money while you sleep, or do you have to sell it to see returns? 3. Tax efficiency, will taxes eat up your profits? We'll see which of these can save you the most. 4. Risk level, how much could you lose, and how volatile is the investment? 5. Results, let's get real. How much has my $100 grown, or shrunk, over the past 4 years? Now, before we dive in, I need to make something clear. I'm not a financial advisor. What I'm sharing here are my personal results and strategies that worked for me. Always do your own research and make sure you understand what you're getting into. Let's kick things off with individual stocks. 1. Individual stock. Investing in individual stocks can feel like the ultimate financial challenge. It's an exciting but high-risk option for any beginner. Imagine owning a slice of a company that you believe in, whether it's a tech giant like Apple or a new startup making waves. This is the foundation of stock market investing, and for many, it's where the magic happens. You pick a company, buy its shares, and wait for its value to rise. But here's the catch: the learning curve can be steep. For those new to investing, understanding financial statements can feel like reading a foreign language. You need to learn how to read balance sheets, analyze profit and loss statements, and understand a company's growth potential. It's not just about picking a name you like or a brand you trust. It's about diving deep into the numbers and market trends. Passive income from stocks can come in 2 forms: appreciation in stock price and dividends. Dividends are regular payouts from the company to its shareholders. However, not all companies pay dividends, so this isn't something you can count on unless you pick specific dividend-paying stocks. Plus, even those dividend stocks don't guarantee steady income. In terms of tax efficiency, individual stocks can be a double-edged sword. On the one hand, if you buy and sell through a tax-advantaged account like a Roth IRA in the US, you can shield those gains from taxes. However, if you're trading stocks in a taxable account, the capital gains tax can eat into your profits, especially when you sell for a profit within a short time. The risk is where the real challenge lies. The stock market can be unpredictable, even for the most seasoned investors. As much as you can gain, you can also lose. The key to successful stock investing lies in doing your research, diversifying, and keeping a long-term outlook. Many investors get burned by trying to time the market, but a steady and informed strategy can make all the difference. 2. Real estate investment trusts, REITs. If you're looking to get into real estate investing without the hassle of managing physical properties, real estate investment trusts, REITs, might be the way to go. Essentially, REITs allow you to invest in a diversified portfolio of properties, including commercial real estate, apartment complexes, and industrial spaces, without owning them directly. This makes real estate investment more accessible to people who don't have tens of thousands of dollars to spare for down payments or want to avoid the headaches of property management. One of the things that make REITs attractive is their learning curve. It's much lower than investing in individual stocks or physical real estate. Instead of needing to learn about mortgages, property taxes, and upkeep, with REITs, you simply invest in a fund that handles all of that for you. The real work comes in researching which REITs to invest in. Not all REITs are created equal, so you'll need to look at things like the type of properties they own, their track record of dividends, and how the real estate market is performing. When it comes to passive income, REITs shine. Since they are required by law to distribute 90% of their taxable income as dividends, they can provide a steady cash flow to investors. This is a big plus for those seeking an income stream without having to lift a finger. However, these dividends are also tied to the performance of the properties the REIT owns, so they're not guaranteed. In other words, if a company is struggling or the real estate market takes a hit, your dividends could be lower. As for tax efficiency, REITs offer some advantages. In the US and UK, you can invest in REITs through tax-advantaged accounts like IRAs or ISAs, which means you can avoid paying taxes on dividends and capital gains. However, outside of these accounts, REITs are taxed similarly to ordinary income, so taxes can cut into your returns if you're not careful. The risk of REITs is moderate. While they don't carry the same volatility as individual stocks, they are still subject to the ups and downs of the real estate market. A dip in the property market can lead to a decrease in dividends or the value of your investment. 2. The real estate investor. Investing in real estate has long been considered one of the most reliable ways to build long-term wealth. The idea of owning physical property or assets that grow in value over time is a powerful draw for many investors. However, traditional real estate investing typically requires significant capital. With $100 in hand, it may seem like a stretch to even consider real estate as a viable option. But what if I told you that you can still invest in real estate with just $100? Let me show you how. Real estate investment doesn't always have to mean buying a house or apartment directly. There are other, more accessible routes that allow you to benefit from the property market, and it all starts with understanding real estate investment trusts, or REITs. What are REITs? A real estate investment trust, REIT, is a company that owns, operates, or finances income-producing real estate. Instead of buying property directly, REITs allow individual investors to pool their money together to invest in commercial real estate, such as office buildings, shopping centers, or apartment complexes. REITs are traded on major stock exchanges, much like stocks. So, if you can buy stocks with $100, you can invest in real estate via REIT with the same amount of capital. Why should you invest in REITs? REITs offer several advantages for beginner investors. For starters, they provide access to high-quality real estate portfolios without requiring large sums of money up front. Historically, REITs have shown attractive returns, providing investors with a reliable income stream in the form of dividends. If you're aiming for passive income, REITs are an excellent option as they are legally required to distribute at least 90% of their taxable income to shareholders. Moreover, REITs are highly liquid compared to physical real estate, meaning you can buy and sell your shares easily. This liquidity makes REITs an appealing option for someone who wants to dip their toes into real estate without being tied to the long-term commitment of buying a property. Types of REITs to consider. There are different types of REITs to consider, depending on your risk tolerance and investment goals. 1. Equity REITs. These REITs own and operate physical properties, like office buildings, hotels, and shopping malls. 1. They earn income through rents and lease agreements with tenants. 1. Equity REITs tend to offer a steady stream of income through dividends but can be vulnerable to market volatility, especially during economic downturns. 2. Mortgage REITs, MREITs. Instead of owning properties, mortgage REITs provide financing for real estate owners and operators. 2. They earn income by lending money to property developers or purchasing mortgages from financial institutions. 2. Mortgage REITs can offer higher yields, but they also come with more risk due to interest rate fluctuations and credit risks. 3. Hybrid REITs. As the name suggests, hybrid REITs combine both equity and mortgage strategies. 3. They invest in both physical properties and mortgage-related assets. 3. This diversification can provide a balance between income and risk. How to invest with $100? Investing in a REIT is as simple as buying shares in any publicly traded company. With platforms like Robinhood, E-Trade, and Vanguard, you can purchase shares in REITs with as little as $100. Look for a REIT that aligns with your financial goals, whether it's generating passive income, growing your wealth over time, or diversifying your portfolio. Many REITs are available with low entry costs and offer dividends that you can reinvest to grow your position even further. In fact, reinvesting those dividends can create a compounding effect, potentially increasing the value of your investment exponentially over time. Another way to start is through real estate crowdfunding platforms, which pool funds from multiple investors to fund real estate projects. Platforms like Fundrise or Realty Mogul allow you to start investing with as little as $100. These platforms offer a variety of investment options, from residential to commercial properties, and provide a more hands-off approach for investors. The risks and rewards, like any investment, real estate investments through REITs or crowdfunding come with risks. The real estate market is cyclical, meaning that property values can go up or down based on a variety of economic factors, including interest rates, employment rates, and market conditions. If the real estate market faces a downturn, your investment could lose value. However, the reward of real estate investing is undeniable. While stocks and bonds can be volatile, real estate has traditionally been a stable asset class, especially when it's diversified across multiple properties and regions. Even with $100, you're gaining exposure to a multi-million-dollar portfolio of real estate, which would have been otherwise inaccessible without significant capital. Conclusion: real estate investing with just $100 might not seem like an obvious choice, but with the rise of REITs and crowdfunding platforms, you can get started with minimal risk and effort. These investment vehicles offer an affordable and easy entry point for individuals interested in tapping into the lucrative world of real estate. By investing in REITs or similar platforms, you can build a diverse, long-term investment portfolio that generates income while mitigating the risk of directly buying and managing property. So, don't let your $100 sit idle. Consider real estate as a way to start building your wealth, even if you're not in a position to purchase physical property just yet. Over time, the growth potential in the real estate sector could become an essential part of your broader investment strategy. This version should provide a more comprehensive and detailed narrative for someone looking to get into real estate investment, even with a modest amount of capital like $100. It outlines the concept of REITs, the different types, and the ways to start investing, along with potential risks and rewards. Let me know if you'd like further adjustments. 3. Cryptocurrency. Cryptocurrency is a whole new world, and entering it with only $100 might seem daunting, but it also holds the potential for enormous rewards. Cryptos like Bitcoin, Ethereum, and others have been at the forefront of the financial revolution, providing a way to invest outside traditional markets. With a market capitalization in the trillions, cryptocurrencies have proven to be resilient, but that doesn't mean they're without risk. The learning curve when it comes to cryptocurrency can be challenging. To start, you'll need to grasp the basic concepts of blockchain technology, which underpins most digital currencies. This includes understanding how cryptocurrencies are mined, how transactions are verified, and how the decentralized nature of these currencies makes them different from traditional ones. On top of that, you need to figure out how to securely store your crypto. There's no FDIC insurance here, so a hack or forgotten password could mean losing your investment. One of the attractions of cryptocurrency is the potential for passive income. This can come in the form of staking, lending, or yield farming, where you lock up your crypto in a digital wallet and earn interest or other rewards in return. However, these opportunities come with risks, and you'll need to ensure that you're using a reputable platform to avoid losing your crypto to scams. As for tax efficiency, crypto falls into a gray area. Many countries have started to tax crypto investments, so your gains may be subject to capital gains taxes depending on how long you hold the asset and how much profit you make. However, there's no specific tax advantage for holding crypto in a tax-advantaged account like an IRA or ISA. Risk is the major factor here. Cryptocurrencies can fluctuate wildly in price. In fact, it's not uncommon to see a coin's value drop by 20% or more in a single day. On the flip side, massive gains are possible, and this is what draws so many to the space. My $100 investment in Bitcoin turned into over $650, thanks to the explosive rise of the cryptocurrency over the last 4 years, but not all coins perform as well. It's not for the faint-hearted, and while the rewards can be significant, you need to be prepared for major volatility. As for passive income, it's possible with staking and yield farming, but it's not as easy as with stocks or REITs. You can earn rewards for staking your crypto, or lend it out to earn interest. But, and this is important, the risks are high. The value of your coins can drop at any moment, and if you're not careful, you could lose everything. For tax efficiency, crypto isn't great. Many countries tax crypto transactions, and you can't use tax-advantaged accounts like a Roth IRA or stocks and shares ISA for crypto. Risk is very high. Cryptocurrencies are incredibly volatile. I invested $100 in Bitcoin 4 years ago, and today it's worth $652.124. That's a return of 552%, but this is unusual. Most cryptos don't see returns like this. 4. Gold. Gold has stood the test of time as one of the most reliable forms of wealth preservation. Throughout history, gold has been used as currency and a store of value, making it a timeless option for investors who are looking for stability. In an unpredictable world, gold remains a safe haven that many turn to during times of economic uncertainty. The learning curve when it comes to investing in gold is fairly low. Gold is simple. Either you buy physical gold in the form of coins, bars, or jewelry, or you invest in gold ETFs, which track the price of gold without requiring you to hold the physical metal. The benefit of gold ETFs is that they're easily tradable, and you don't have to worry about security or storage like you would with physical gold. If you want to hold physical gold, you can buy coins or bullion from dealers or even at auction. Passive income from gold is essentially non-existent. Gold doesn't pay dividends or generate interest. Its value grows, or falls, based on market demand and geopolitical factors. However, gold's primary value proposition is as a hedge against inflation. In times of economic crisis, people flock to gold as a safe store of value, often pushing the price upward. If you're holding gold during these times, you could see significant returns. When it comes to tax efficiency, gold is an attractive option. In many countries, certain forms of gold, such as certain gold coins in the UK, are exempt from capital gains taxes. If you invest in gold ETFs, you may be subject to taxes, but holding them in a tax-advantaged account like a Roth IRA in the US can allow you to bypass those taxes. Risk with gold is low compared to stocks and cryptocurrencies. While it doesn't offer the explosive returns you might see with more volatile assets, it's far less likely to lose its value. Gold is a reliable, long-term store of wealth, and even when the market experiences downturns, gold often rises as a hedge against inflation and political uncertainty. My $100 investment in gold grew by 40% over 4 years, which might not sound dramatic, but that's the beauty of gold: slow, steady growth with minimal risk. 5. Index funds. If you're looking for a way to invest your $100 and let it grow over time without constant monitoring, index funds might be the perfect solution. These funds are essentially baskets of stocks that track a specific market index, such as the S&P 500, which includes the 500 largest companies in the US. Index funds are perfect for those who don't have the time, knowledge, or desire to pick individual stocks. Instead of worrying about which company will outperform the rest, you invest in the market as a whole. The learning curve for index funds is incredibly low. You don't need to research individual. The learning curve here is low. It's a passive investment, no need to pick individual stocks. You just invest in the fund, and it takes care of the rest. For passive income, index funds don't pay a lot in dividends, but many of the companies in the fund do, and that income gets reinvested. Tax efficiency is great. You can hold index funds in a tax-advantaged account like a Roth IRA or stocks and shares ISA, which means you won't pay taxes on your profits. Risk is low. Index funds are diversified, meaning your money is spread across many companies. Historically, they provide steady, long-term growth. Over the last 4 years, my $100 investment in an S&P 500 fund is now worth $179.53, a 57% return. In today's world, where social responsibility and purpose-driven business models are becoming more prominent, social entrepreneurship offers an incredible opportunity to create a meaningful impact while making a profit. What if you could leverage that $100 to launch a small venture that benefits both your community and the environment? This is where social entrepreneurship comes in. As a social entrepreneur, your goal is not just to generate financial returns, but also to address pressing social issues, whether it's poverty, environmental sustainability, education, or access to healthcare. The beauty of social entrepreneurship is that it merges the best of both worlds, making a difference and making money. And with just $100, you can absolutely start small and scale up over time. Start by identifying a local problem that needs solving. For instance, you might create a small business that upcycles old clothing, turning them into new, fashionable pieces while reducing waste. Or perhaps you could launch a microloan program that helps people in underserved areas start their own businesses, contributing to economic development in those communities. With $100, you can also explore online platforms like Kickstarter or GoFundMe to fundraise for your idea. Social entrepreneurship isn't just about doing good, it's about finding innovative, sustainable ways to address real-world problems. With passion, determination, and a bit of creativity, you can turn that $100 into a force for good. Whether you're looking for short-term gains or long-term wealth building, each investment option has the potential to fit your unique goals. While $100 may not seem like much at first glance, it's important to remember that every successful investor started somewhere, and every investment journey begins with that first step. From the hands-on nature of picking individual stocks to the hands-off approach of REITs and index funds, the key is to choose what feels right for you and start learning along the way. As with any investment, it's vital to do your research, understand your risk tolerance, and be patient as your money works for you. So, whether you're a cautious investor or an ambitious risk taker, the opportunities are out there. The most important part is to begin. The world of investing is waiting for you, and that $100 might just be the beginning of your financial future. Take the leap, stay informed, and let your money grow.